Hello guys, welcome to a new video. In this video I'm going to be talking about liquidity and how liquidity is a very important factor if you want to learn how to trade. So the basic market structure, we've been taught that liquidity is what money in the market, that we have different types of liquidity, which is true. So in this video I'm going to be going on about the types of liquidity that we have and why you should avoid some certain zones because of liquidity. So we have what we call equal lows or equal highs. This is where you see from the name equal, like can I give example? So you can see something like this: equal lows, relatively equal highs or lows. So relatively equal highs. Anytime we see something like this here, most likely on the lower time frame it's going to get taken out, even on a higher time frame. But the way smart money traders are reading this liquidity and expecting that if relatively equal highs and relatively equal lows are taken out, then the real move will happen. But smart money, basic smart money concept has now become liquidity. Basic smart money concept has now become liquidity. I'll explain everything to you guys. Just keep watching. And by the way, if you want to level up your trading, book up 30-minute call with me, one-to-one. If you want to take your trading from being a beginner or being an unprofitable trader to the next level, hit me up. And then we have equal lows. Just basically where money is sitting in the market. This is liquidity. And what do you expect? You expect price to take you out, then the real move will happen. Okay. So we have relatively equal lows. It mustn't have to be equal, exactly equal. Just understand the concepts. That is why the relatively is there. Then we have trendline liquidity. We have what we call trendline liquidity. This is the most common one. We always see price building up trendline liquidity. Guys, I'm going to teach you guys how to read liquidity different from anybody else. So we have relatively equal highs. What smart money traders has been taught is that basically if there are equal highs, price will induce the equal highs, take them out, and then give confirmation and the real move happens. Okay? Pure SMC, smart money concept. And then if there are equal lows, price will sweep them before the real move happens, and then whenever there's a confirmation, price will come back and the move will happen. But when there's trendline liquidity, price will take it out, then give confirmation, and the real move happens. But all these concepts have become liquidity as well. So somebody that is waiting for the relatively equal highs, relatively equal lows, or trendline liquidity to get taken out before entering a trade will later also get taken out because all these concepts are outdated. Smart money concept is also liquidity. That's what I want you guys to understand. So whenever you see price taking out these guys that trade this pure liquidity build up and inducement and change of character, whenever I see price giving them a reaction and then taking them out again and then the real move happening, it's all due to the understanding of liquidity. Because these guys now are thinking that they are the most profitable ones because what they are waiting for equal highs or equal lows to get taken out before they enter their trade, and then they wait for confirmation and then get into a trade. But let's say we have equal highs building up here, and then they waited for price to induce it, they waited for confirmation, they enter the trade, and then they expect the price to go higher. And do you know what happens? Price will just come and take them out again, and then the real move happens. That's how it works, guys. So smart money traders are also becoming liquidity. Don't get me wrong, I know a lot of smart money traders that are very, very profitable. So the next form of liquidity I want to explain to you guys is structural liquidity. It is what? Structural liquidity. And as I explained in my previous video, we know this to be what structure. From this higher low to this higher high is a what new structure. So all these points are what structure points. So structural liquidity is found between the what high and the lows of the structure basically. So this is what structural liquidity. This is what structural liquidity. This is what structural liquidity. As easy as simple as that, guys. If you guys notice, I've been explaining all these concepts in a very, very simple way that you guys will understand. So once you understand structural liquidity and how it's being taken out, you understand that trading is all about being patient. Patience is the name of the game. So let's say you're in a buy scenario now and you're expecting the market structure we've all been taught is that whenever there's a break of structure, yeah, price will come back to this level of demand and then buy up. That's what we've been taught. Yes. But price will not just be going bullish without inducing liquidity. There has to be a form of inducement of liquidity. Inducement of liquidity is price building up liquidity and taking it out. All these are what forms of liquidity. So usually what happens is we are bullish here. A lot of people are expecting price to buy from here, or they're expecting to enter longs from here. So what happen? Price will take out this liquidity, this structural liquidity, and tap into this zone and continue going up. So this served as liquidity for this pure Y to hold. Liquidity must be taken for price to continue its move. Yeah, so we've talked about relatively equal highs, relatively equal lows, trendline liquidity, and structural liquidity. So, sorry guys. So when we're looking for buyers, what we should be focusing on is liquidity and, most importantly, premium and discounted area. So as I explained in my previous video, I said whenever price sweeps liquidity and breaks structure, you're going to expect what did I say? If you know, please leave a comment. When I was talking about swing high, swing low, price is going to retrace back into the premium area and then continue going back up. That's why I said, yeah, whenever there's a break of structure, price is going to come back down. Price is going to come back down, which is called the retracement. Price is going to retrace back to the premium zone. This is our premium zone. And what did I say about looking for buys? You shouldn't be looking for buys here. Sorry, this is our discounted zone. Sorry guys, I don't know why I mixed it up. This is our discounted zone. And you shouldn't be looking for buys at what? Premium zone. You should always be looking for buy at discounted zone, and anything below the 50% is our discounted zone. So whenever price comes down, which is called a retracement, you should expect price to retrace below the 50%, which is our discounted zone, before you look for buys. Okay, so whenever price is in the premium zone, you're not just meant to put your long position to and just buy. There are certain criteria you have to follow before you take a trade. Okay, I'm giving you guys a checklist here. So when price takes out this low and breaks structure, this is our sweep of liquidity. This is our sweep of liquidity, and is the break of structure. So when it is sweep of liquidity, this becomes our protected low. This becomes our protected low, and we don't expect price to take it out because price has swept liquidity. Whenever a previous low is taken out and you're looking for buys, expect your protected low to be protected from the name protected low, meaning price is not supposed to go below this point. The only thing that can make price go below this point is when there is no liquidity here. This is my next point. So whenever you're looking for buys, price must first sweep liquidity, criteria number 1. Here, checklist number 1, price must sweep liquidity. Price must break structure. As you can see, guys, criteria number one, price has what? Swept liquidity. Criteria number one. Criteria number two, price has what? Broken structure. What's our criteria number three? Hmm? Price let me just put this up there. Check list. Price must come back into the what? Discounted area. This is when we talk about what? Using our Fibonacci tool. Whenever there's a break of structure, you mark your what? I said you mark. You put your Fib tool from your low to your high. As simple as that. And this is my Fib tool settings, guys. I've showed you guys this before. 50, 100, 0. As simple as that. Don't overcomplicate it. Price must come back, retrace back. Price must come back. I said come back just to make you guys understand, but the term to use is what? Retrace. Retrace back to the discounted area. Number 4, checklist. Let's go over this again, guys. Number 1, we said what? Price must sweep liquidity. Number 2, price must break structure to the upside. Number 3, you must use your what? Fibonacci tool. You have to use your Fibonacci tool. Yep. Use your Fibonacci tool to determine what? Premium on the discounted areas. Number 4, price must have built up liquidity in the discounted. I'll just put it discounted area. So as I've been taught, the basic market structure, whenever there's a break of structure, what do? You just what? Buy from here. Whenever there's a break of structure, you just buy from here. Whenever there's a break of structure, you what? You just buy. Nah, that is not how I trade. So what do? This structural liquidity that I explained to you guys, this is called structural liquidity. So in the premium areas, price must have built up liquidity. This is the liquidity I was talking about. This is why I first explained liquidity to you guys. Structural liquidity. Price must have built up liquidity in the discounted area. As you can see now, price has built up liquidity in the what? Discounted areas. So now I can look to buy from this level of demand zone and target a 1 to 3 risk to reward. Price will usually leave level of demand here. And then put your long position to here. Target a 1 to 3 risk to reward. That's it. What's the first criteria, guys? Sweep of liquidity, inducement of liquidity, a break of structure, using your FIB to determine what the discounted areas. 3. Price must have what built up liquidity inside the premium areas. And now we can see what price has built up this trendline liquidity. And then now what do you expect? You expect price to take this out and tap into our zone and fly up. As simple as that. Price basically that's it. Checklist you must have before you consider taking a trade. As simple as this, guys. So now let's go to the 1 hour time frame to see if I can find an example to show you guys. What's our first checklist? A sweep of liquidity. Sweep of liquidity. Okay. It was a break of structure. Checklist number 2. What do we do now? Use our Fibonacci tool to determine premium and discounted areas. Now, what are we looking for? We're looking for buys, so we're looking for price to retrace back into the premium areas, discounted areas before flying off. And we don't want to look for buys anywhere between the premium areas and the equilibrium. So now, let's put our Fibonacci tool. Now, what do we want? We don't want to be looking for buys anywhere here. We don't want to be looking for buys or anywhere here. We want to be looking for buys anywhere below 50%. Okay. Now, checklist number what? Number 1. Number 2, break of structure. Number 3, using our Fibonacci tool. Number 4, determining discounted areas. Okay. Number 5, we're looking for structural liquidity. Now, where structure? We'll mark our structure: higher low, higher low, higher high, higher low, higher high. Which low can we see before the previous low here? This one, level of demand. You can see this level of structure that we expect price to take out. And then what do you expect price to do? You expect price to tap into our level of demand. Got this level of demand here. And then we target our what? 1 to 3. If you want, you can even target this overall high. Guys, is that easy? Don't overcomplicate it. Checklist number 1, waited for a what? A sweep of liquidity, waited for a break of structure. We used our Fibonacci tool to determine this is the premium areas, this is equilibrium, and then this is discounted areas. We waited for price to hit the discounted areas, and then what? We looked for what? The liquidity that has been built up. We have this level of liquidity I have this equal lows here. Price, expect price to take it out, tap into a level of demand, and then boom. I know you guys will not find this easy to understand, but I tried my best to not complicate this thing to you guys. There's a lot more to this, but just understand this simple checklist before we proceed. A lot of videos will be dropping on this YouTube channel, guys. A lot of videos will be dropping in our YouTube channel. Okay. Alright, guys, if you found this very helpful, make sure you leave a like and more videos coming from me. Thank you.